Question 1. A registered options principal, ROP, is reviewing a new options account application for a customer who explicitly states speculation as their investment objective and requests approval for uncovered option strategies, despite having a moderate net worth and limited prior options experience. Which of the following is the most crucial initial step for the ROP? Approve the account for all requested strategies, assuming the customer signed the options disclosure document, ODD. B. Disapprove the account entirely, as speculation is an unsuitable objective for a new options trader. C. Contact the customer to further assess their financial situation, investment experience, and understanding of the risks involved. Approve the account for covered calls and protective puts only, deferring more complex strategies. Answer: C. Contact the customer to further assess their financial situation, investment experience, and understanding of the risks involved. Even when a customer states an objective like speculation, the registered options principal, ROP, has a fundamental responsibility to conduct due diligence to ensure the requested strategies are suitable. This involves thoroughly assessing the customer's financial situation, investment experience, and their understanding of the specific risks associated with uncovered option strategies, which can carry significant risk. Simply relying on the customer's stated objective or ODD signature without further inquiry is insufficient for meeting suitability obligations. The ROP must ensure the customer genuinely understands and can financially bear the risks before approving for complex, high-risk strategies. Question 2. A Series 9 options principal is responsible for ensuring the firm's written supervisory procedures, WSPs, regarding options trading are current and effective. Which of the following statements best describes the primary consideration when designing and implementing these WSPs? They must strictly adhere to OCC requirements for contract standardization, regardless of trading volume. B. They should be generic enough to apply to all financial products offered by the firm, ensuring consistency across departments. C. They must be specifically tailored to the firm's options business, including the types of options products offered, customer base, and supervisory structure. They primarily serve as a historical record of compliance, reviewed only when a violation occurs. Answer: C. They must be specifically tailored to the firm's options business, including the types of options products offered, customer base, and supervisory structure. Written supervisory procedures, WSPs, must be dynamic, comprehensive, and specifically tailored to the particular business activities of the firm. For an options principal, this means the WSPs must address the unique risks and regulatory requirements of options trading, considering the specific products offered, the types of customers served, and the firm's overall supervisory structure. Generic procedures that apply to all products would likely be inadequate for the specialized nature of options, and WSPs serve as a proactive framework for compliance, not merely a reactive record. Question 3. A registered options principal, ROP, is reviewing a new retail communication that promotes the use of options for income generation through covered call writing. To comply with FINRA rules, which of the following statements must be included in this communication? A projection of potential monthly income based on current market conditions. B. A balanced discussion of both the risks and potential benefits of covered call writing. C. A disclaimer that past performance is not indicative of future results, but only if specific performance figures are included. A recommendation to consult with a tax advisor regarding the tax implications of options. Answer: B. A balanced discussion of both the risks and potential benefits of covered call writing. FINRA rules require that all retail communications, especially those concerning options, present a balanced picture. This means clearly disclosing both the potential benefits and the significant risks associated with any option strategy, such as covered call writing, even though it is considered a relatively conservative strategy. Projections of income are generally prohibited or heavily restricted, and while tax advice disclosure is good practice, a balanced discussion of risks and benefits is a fundamental requirement for all options communications. Question 4. A customer with an approved options account informs their registered representative, RR, of a significant change in their financial situation, e.g., loss of employment, and requests to maintain their current options trading level, which includes uncovered strategies. What is the ROP's most critical immediate action after assessing the change's impact on suitability? Advise the customer to cease trading immediately until their financial situation stabilizes. B. Update the customer's account records to reflect the new financial situation and reclassify their suitability level, if necessary. C. Liquidate all uncovered option positions to reduce risk to the customer and the firm. Inform the customer that their previous options agreement is now void and a new one must be signed. Answer B. Update the customer's account records to reflect the new financial situation and reclassify their suitability level, if necessary. When a customer's financial situation significantly changes, particularly in a way that impacts their ability to bear the risks of existing strategies, the Registered Options Principle, ROP, must first reassess suitability. Following this assessment, the crucial step is to update the customer's account records to accurately reflect their new financial status and investment capacity. This may also involve reclassifying their suitability level and discussing appropriate adjustments to their trading authorizations, rather than immediately halting trading or liquidating positions without proper assessment and documentation. A new options agreement is typically not required unless there's a fundamental change in account type or structure, not just a change in suitability. Question 5. An options principal is responsible for the review of options order tickets. Which of the following practices by a registered representative would most likely trigger an immediate flag and require further investigation by the principal? Frequent small-value options trades for an experienced customer with a large portfolio. B. Placing a series of unsolicited buy-limit orders for equity options below the current market price. C. Executing numerous options trades in a discretionary account without prior client consultation. Receiving a single sell-to-close order for an expiring in-the-money call option. Answer C. Executing numerous options trades in a discretionary account without prior client consultation. Executing numerous options trades in a discretionary account without prior client consultation, especially if the account is not properly authorized for discretionary trading, is a serious violation and a red flag for potential unauthorized trading or excessive activity. Churning? An options principal must closely supervise discretionary accounts and ensure all trades are authorized or properly documented within the scope of a signed discretionary agreement. The other options, while requiring review, do not inherently indicate immediate rule violations as severe as unauthorized discretionary trading. Question 6. According to FINRA rules, what is the maximum number of standard options contracts on the same side of the market that a customer may hold for a single underlying security without specific exchange approval? 250,000 contracts. B. 500,000 contracts. C. 1 million contracts. The limit varies depending on the underlying security and must be checked with the Options Clearing Corporation, OCC. Answer. The limit varies depending on the underlying security and must be checked with the Options Clearing Corporation, OCC. Options position limits are established by the options exchanges and FINRA, and they vary significantly depending on the underlying securities trading volume, outstanding shares, and market capitalization. There is no single universal maximum limit like 250,000 or 500,000 for all securities. Therefore, an options principal must regularly check the specific limits for each underlying security with the relevant options exchanges or the Options Clearing Corporation, OCC, to ensure compliance and proper supervision of customer accounts. This rule prevents any single investor from unduly influencing the market for a particular option. Question 7. A registered options principal, ROP, discovers that a registered representative, RR, failed to provide the options disclosure document, ODD, to a new customer at or before the time the options account was approved. What is the most appropriate immediate action for the ROP? Close the customer's options account immediately and liquidate all positions. B. Deliver the ODD to the customer immediately and have them sign an acknowledgement of receipt. C. Issue a formal warning to the RR and monitor future ODD deliveries. Report the RR to FINRA for a serious violation of sales practice rules. Answer B. Deliver the ODD to the customer immediately and have them sign an acknowledgement of receipt. Failing to deliver the options disclosure document, ODD, is a serious rule violation, as the ODD provides critical risk information to customers. The most appropriate immediate action for the registered options principal, ROP, is to rectify the oversight by promptly delivering the ODD to the customer and documenting the delivery, typically through a signed acknowledgement. While disciplinary action against the RR may follow, ensuring the customer receives the mandated disclosure is the immediate priority to mitigate harm and address the regulatory breach. Liquidating positions might not be in the customer's best interest, and reporting to FINRA is usually for severe or repeated offenses after internal rectification attempts. Question 8. Which of the following scenarios would most likely necessitate a registered options principal, ROP, to implement enhanced supervision for a specific registered representative, RR? The RR consistently meets sales quotas and has no customer complaints. B. The RR is newly licensed but only solicits covered call strategies for high-net-worth clients. C. The RR has a history of suitability violations and has recently transferred from another firm. The RR primarily deals with institutional clients and rarely uses complex option strategies. Answer: C. The RR has a history of suitability violations and has recently transferred from another firm. A history of suitability violations, especially when combined with a transfer from another firm, indicates a heightened risk and necessitates enhanced supervision. This scenario suggests a pattern of behavior that could lead to customer harm and regulatory breaches, requiring the ROP to implement more stringent oversight, such as closer review of all new account applications, daily trade blotters and customer communications. Other scenarios might require standard supervision, but a history of violations demands a more proactive and intensive supervisory approach. Question 9. When a broker-dealer receives a customer complaint regarding an options trade, which of the following is the options principal's most critical immediate responsibility? Attempt to resolve the complaint directly with the customer to avoid escalation. B. Forward the complaint to legal counsel for review and response. C. Ensure the complaint is recorded in the firm's complaint log and investigate the allegations promptly. D. Instruct the registered representative involved to contact the customer and address their concerns. Answer: C. Ensure the complaint is recorded in the firm's complaint log and investigate the allegations promptly. Upon receiving a customer complaint, the options principal's most critical immediate responsibility is to ensure the complaint is properly recorded in the firm's complaint log, as required by FINRA Rule 4513, and to initiate a prompt, thorough, and impartial investigation into the allegations. This ensures regulatory compliance and facilitates a fair resolution. While resolution is the ultimate goal, proper logging and investigation are foundational steps that must occur first, and instructing the RR to resolve it directly might impede an impartial investigation. Question 10. A firm's written supervisory procedures, WSPs, for options must include specific provisions for the approval and review of retail communications. What is the minimum requirement for the approval of such communications before first use? Approval by any registered representative. B. Approval by a general securities principal, Series 24. C. Approval by a registered options principal, Series 9/10. Approval by a compliance officer, regardless of their principal registration. Answer: C. Approval by a registered options principal, Series 9/10. FINRA rules specifically require that all retail communications pertaining to options be approved by a registered options principal, ROP, or a general securities sales supervisor, Series 9/10, while a general securities principal, Series 24, can generally approve retail communications. Options communications demand the specialized knowledge and registration of an ROP. This ensures that the complex risks and suitability considerations unique to options are properly reviewed and disclosed to the public. Question 11. A customer holds a short put option position that is significantly in the money as expiration approaches. The customer's account currently holds insufficient funds to cover the potential exercise and purchase of the underlying stock. What action must the registered options principal, ROP, ensure is taken? Advise the customer to allow the option to expire unexercised to avoid incurring a debit. B. Contact the customer to arrange for the necessary funds or instruct them to close the position. C. Automatically close out the customer's short put position at market to prevent a margin call. Notify the Options Clearing Corporation, OCC, that the customer may default on their obligation. Answer: Contact the customer to arrange for the necessary funds or instruct them to close the position. When a customer holds a short option position that is in the money near expiration and lacks the funds to cover potential exercise, the Registered Options Principal, ROP, must ensure the firm contacts the customer. The customer must either be instructed to deposit the necessary funds to meet the obligation or to close out the position to mitigate potential losses and avoid a forced liquidation by the firm. The firm cannot simply allow the option to expire, nor can it unilaterally close the position without customer instruction unless specified in the customer agreement after attempts to contact. Notifying the OCC is not the primary initial action for an individual customer's margin issue. Question 12. An options principal is performing an annual review of a branch office. Which of the following is most critical for the principal to assess regarding options transactions? The average profit margin on all options trades executed by the branch. B. The number of options contracts traded compared to equity shares. C. Compliance with suitability requirements and proper documentation for options account approvals. D. The marketing strategies used to attract new options clients. Answer: C. Compliance with suitability requirements and proper documentation for options account approvals. During a branch office inspection, the most critical aspect for an options principal to assess regarding options transactions is compliance with suitability requirements and the proper documentation of options account approvals. Ensuring that options accounts are only opened for suitable customers and that all required disclosures, agreements, and approvals are in place is paramount to investor protection and regulatory compliance. While other factors might be reviewed, suitability is at the core of responsible options sales practices. Question 13. Under FINRA rules, when must the customer receive a current options disclosure document, ODD? At the time of the first options trade. B. At or before the time the customer's account is approved for options trading. C. Within 15 days after the first options trade. D. Upon request from the customer only. Answer: B. At or before the time the customer's account is approved for options trading. FINRA rules explicitly state that a broker-dealer must furnish a current options disclosure document, ODD, to the customer at or before the time the customer's account is approved for options trading. This ensures the customer receives comprehensive information regarding the risks and characteristics of options prior to being authorized to engage in options transactions, allowing them to make informed decisions. Delaying the ODD delivery until after approval or the first trade would defeat the purpose of informed consent. Question 14. An options principal discovers that a registered representative, RR, has been consistently recommending a specific complex options strategy to customers without thoroughly understanding its intricacies or potential risks. What is the principal's immediate responsibility? Approve the trades as long as the customers sign the options agreement. B. Require the RR to cease recommending that strategy immediately and provide remedial training. C. Monitor the RR's activity for a few weeks to see if performance improves. D. Assume the RR is acting in the customer's best interest if no complaints have been received. Answer: B. Require the RR to cease recommending that strategy immediately and provide remedial training. If an options principal discovers a registered representative, RR, is recommending complex strategies without proper understanding, the immediate responsibility is to halt such recommendations and provide remedial training. An RR must possess a thorough understanding of any product or strategy they recommend to customers to ensure suitability and proper disclosure of risks. Allowing the RR to continue risking customer funds due to their lack of knowledge is a severe supervisory failure and could lead to customer harm and regulatory penalties. Question 15. Which of the following would not be considered an appropriate element to include in a firm's written supervisory procedures, WSPs, specifically for options trading? Procedures for initial and ongoing suitability determinations for options accounts. B. Guidelines for the review and approval of options-related retail communications. C. Specific thresholds for options position limits and how to monitor for compliance. Detailed instructions on how to execute specific options trading algorithms for proprietary trading. Answer: Detailed instructions on how to execute specific options trading algorithms for proprietary trading. While a firm's WSPs must cover all aspects of its business, including proprietary trading, Detailed instructions on how to execute specific options trading algorithms for proprietary trading are generally operational procedures for traders, not necessarily part of the supervisory framework for customer accounts or general options oversight that a Series 9 principle focuses on. WSPs for options principles primarily address regulatory compliance, customer protection, suitability, and the supervision of registered representatives and their activities, not proprietary trading mechanics. The other options are all critical components of an ROP's supervisory responsibilities. Question 16. A customer initiates a complaint alleging that their registered representative engaged in excessive trading, churning, in their options account. What is the best indicator for the options principle to initially investigate to determine if churning may have occurred? The total commissions generated from the options account. B. The number of options contracts traded relative to the account size and investment objectives. C. The customer's reported understanding of each trade at the time of execution. D. The overall profit or loss in the customer's account during the period. Answer B. The number of options contracts traded relative to the account size and investment objectives. While total commissions and overall profit/loss are relevant, the best initial indicator to investigate for churning is the activity level of the account relative to its size and the customer's investment objectives. Churning involves excessive trading to generate commissions, which often manifests as a high turnover rate or a large number of trades that do not align with a conservative or moderate objective. An options principle would examine the ratio of trading activity to account equity and the suitability of the volume of trades for the customer's stated goals. Question 17. A registered options principle, ROP, receives an internal report indicating several instances where a registered representative, R, failed to promptly update customer account information, specifically regarding changes in financial status and investment objectives. What is the ROP's most appropriate supervisory response? Assume the changes were minor and had no material impact on suitability. B. Issue a written warning to the RR and conduct a review of all impacted customer accounts. C. Require the RR to retake their Series 7 exam to ensure they understand suitability rules. B. Notify FINRA immediately of the RR's non-compliance. Answer B. Issue a written warning to the RR and conduct a review of all impacted customer accounts. Failure to update customer account information, especially regarding financial status and objectives, is a serious suitability concern that requires immediate supervisory action. The most appropriate response is to issue a written warning to the registered representative, R, to address the specific violation and to conduct a thorough review of all accounts handled by that RR to assess if any unsuitable trades occurred as a result of the outdated information. This ensures both disciplinary action and remediation for affected clients. Question 18. When reviewing options advertising, an options principle must ensure that any mention of potential returns or profits is displayed prominently as a guaranteed return. B. Accompanied by an equally prominent discussion of the associated risks. C. Only presented as historical performance without future projections. D. Qualified with the phrase, results may vary, without further explanation. Answer B. Accompanied by an equally prominent discussion of the associated risks. FINRA rules for options communications require a balanced presentation. If any potential returns or profits are mentioned in advertising, they must be accompanied by an equally prominent and balanced discussion of the associated risks. This ensures that investors are fully aware of both the upside and downside potential of option strategies. Presenting returns as guaranteed, only showing historical performance without context, or merely using a generic disclaimer without detailed risk disclosure would be insufficient or misleading. Question 19. A customer in an approved margin account wants to write an uncovered call option. Which of the following statements regarding the initial margin requirement for this transaction is most accurate? The initial margin requirement for uncovered calls is typically 100% of the premium received. B. The initial margin requirement is determined by Regulation T, but specific amounts depend on the underlying stock's value and volatility. C. Uncovered options writing is not permitted in a standard margin account, only in cash accounts with sufficient equity. The initial margin requirement is a fixed percentage, usually 50% of the underlying stock's value, regardless of the option's premium. Answer B. The initial margin requirement is determined by Regulation T, but specific amounts depend on the underlying stock's value and volatility. The initial margin requirement for writing uncovered call options is complex and is indeed determined by Regulation T, but the specific percentage calculation depends on the underlying stock's current market value and volatility, often involving a percentage of the underlying's value minus out-of-the-money amount, plus the premium. It is not a fixed percentage or simply 100% of the premium received. Uncovered options are permitted in margin accounts, not cash accounts, requiring significant collateral. An ROP must ensure customers meet these requirements and understand the margin calls associated with such strategies. Question 20. What is the primary purpose of an options agreement, signed by the customer? To authorize the broker-dealer to make discretionary trades in the customer's options account. B. To acknowledge receipt of the options disclosure document, ODD, and agree to comply with exchange rules. C. To guarantee the customer will not incur losses in their options trades. D. To limit the broker-dealer's liability for any losses suffered by the customer. Answer B. To acknowledge receipt of the options disclosure document, ODD, and agree to comply with exchange rules. The primary purpose of the options agreement, which a customer must sign and return, is to acknowledge that they have received and understood the options disclosure document, ODD, and agree to abide by the rules and regulations of the options exchanges and the Options Clearing Corporation, OCC. It serves as the customer's formal acceptance of the terms and conditions for trading options and is a critical component of suitability and compliance. It does not authorize discretionary trading, guarantee profits, or limit the firm's liability for its own wrongdoing. Question 21. An options principal is notified that a registered representative, RR, executed several customer options orders outside the firm's normal business hours and used personal email for trade confirmations. Which of the following is the most severe compliance concern? The timing of the trades being outside normal business hours. B. The use of personal email for trade confirmations. C. The potential for inadequate record-keeping of the communications. D. The possible circumvention of the firm's supervisory procedures for order review. Answer: the possible circumvention of the firm's supervisory procedures for order review. While all listed actions present compliance concerns, the most severe is the potential circumvention of the firm's supervisory procedures for order review. Executing trades outside normal channels and using unauthorized communication methods, like personal email, strongly suggests an attempt to bypass the required oversight and controls designed to protect customers and ensure regulatory compliance. This behavior indicates a breakdown in supervision and poses significant risks for unauthorized trading, suitability violations, and improper record-keeping. Question 22. Which of the following is not a responsibility of a registered options principal, ROP, concerning customer options accounts? Reviewing and approving all new options accounts. B. Ensuring that all options communications are fair and balanced. C. Executing options trades for customers who lack the knowledge to do so themselves. D. Supervising registered representatives' compliance with options rules. Answer: C. Executing options trades for customers who lack the knowledge to do so themselves. A registered options principal, ROP, is primarily a supervisory role, responsible for overseeing the firm's options activities and ensuring compliance with all relevant rules and regulations. This includes approving accounts, reviewing communications, and supervising representatives. However, an ROP's role does not involve executing trades for customers, especially those who lack the knowledge to trade themselves, as this would violate rules against unauthorized trading and potentially constitute a breach of fiduciary duty if done without proper discretionary authority. Trading is generally the role of a registered representative or floor broker. Question 23. A customer wishes to trade options in an individual retirement account, IRA? The options principal must be aware that all standard option strategies are permitted in an IRA as long as they are suitable. B. Only covered calls and protective puts are generally allowed in an IRA due to IRS regulations. C. Options trading is strictly prohibited in IRAs to prevent excessive risk-taking. Uncovered option strategies are permissible only with a substantial cash reserve in the IRA. Answer: B. Only covered calls and protective puts are generally allowed in an IRA due to IRS regulations. Due to IRS regulations and the tax-advantaged nature of IRAs, most broker-dealers and custodians restrict options trading within these accounts. Typically, only certain conservative strategies like covered call writing, where the underlying stock is held in the IRA, and protective puts are permitted. Uncovered option strategies that involve unlimited risk or are designed for speculation are generally not allowed, regardless of suitability or cash reserves, because they could generate unrelated business taxable income, UBTI, or be deemed too risky for retirement accounts. Question 24. Regarding options exercise limits, a registered options principal, ROP, must monitor customer accounts to ensure that no customer exercises more than 250,000 contracts within a 5-day business period. B. The total number of contracts that can be exercised by any single customer within 5 consecutive business days does not exceed prescribed limits. C. Customers only exercise options that are in the money by at least $0.50 per share. Customers do not exercise options that would result in a position exceeding their original purchase limits. Answer, B. The total number of contracts that can be exercised by any single customer within 5 consecutive business days does not exceed prescribed limits. Options exercise limits are established by the options exchanges and FINRA to prevent market manipulation and ensure fair and orderly markets. A registered options principal, ROP, must monitor customer accounts to ensure that the total number of options contracts on the same side of the market for any single underlying security that can be exercised by a customer or a group of customers acting in concert, within 5 consecutive business days, does not exceed these prescribed limits. These limits vary by underlying security and are distinct from position limits, which govern the total number of contracts that can be held. Question 25. An options principal is conducting an internal review and notices a pattern where a particular registered representatives, RR, customers consistently pay higher commissions on options trades compared to other RRs at the firm for similar trades. What should be the principal's immediate concern? That the RR is providing superior service that justifies higher fees. B. That the RR may be recommending unsuitable option strategies to generate higher commissions. C. That the firm's commission structure is not competitive enough. That these customers are less sophisticated and accept higher costs. Answer, B. That the RR may be recommending unsuitable option strategies to generate higher commissions. A pattern of customers paying consistently higher commissions on options trades for a particular registered representative, R. This should immediately concern an options principal regarding potential suitability issues or even churning. Higher commissions could indicate that the RR is placing an excessive number of trades, recommending more complex or frequent strategies to generate fees, or not achieving best execution, rather than necessarily providing superior service. The principal must investigate whether the trading activity aligns with customer objectives and whether the commissions are reasonable and disclosed. Question 26. Which of the following is a primary responsibility of the Options Clearing Corporation, OCC, that is vital for an options principal to understand? Establishing suitability requirements for options accounts. B. Issuing options contracts and guaranteeing their performance. C. Regulating options exchanges and broker-dealers. D. Setting margin requirements for options positions. Answer, B. Issuing options contracts and guaranteeing their performance. The Options Clearing Corporation, OCC, serves as the issuer and guarantor of all listed options contracts. This means the OCC stands between every buyer and seller, ensuring that the obligations of options contracts, e.g., delivery of shares upon exercise of a call, are fulfilled, thereby reducing counterparty risk. An options principal must understand the OCC's role as central guarantor, as it underlies the integrity and enforceability of all listed options transactions. Suitability and regulation are primarily FINRA and exchange responsibilities, while margin is set by Regulation T and SROs. Question 27. A registered options principal, ROP, is reviewing outgoing correspondence from a registered representative, R, to a customer. The correspondence mentions a specific options strategy and includes a link to an external financial news article. What is the ROP's primary concern? Whether the external article is from a reputable source. B. Ensuring the correspondence meets the definition of retail communication and requires specific approval. C. That the RR has permission to use external links in correspondence. The content of the external article must also be reviewed and supervised as if it were the firm's own communication. Answer. The content of the external article must also be reviewed and supervised as if it were the firm's own communication. When an outgoing communication from a registered representative, RR, includes a link to an external article, the content of that linked article generally becomes attributable to the firm under FINRA Rule 2210, especially if the RR explicitly endorses or recommends it. Therefore, the Registered Options Principle, ROP, must ensure that the content of the external article itself is fair, balanced, not misleading, and complies with all options communication rules, as if it were the firm's own communication. This is a critical supervisory concern to prevent the dissemination of non-compliant or unsuitable information. Question 28. An options principle is establishing a firm's internal controls for preventing front-running. Which of the following would be the most effective control measure? Prohibiting registered representatives from trading options for their personal accounts. B. Implementing strict information barriers between the firm's trading desk and research department. C. Requiring all employees to report their personal options trades to compliance at the end of each month. Establishing pre-trade approval for all employee and proprietary options trades, along with surveillance for suspicious activity. Answer. Establishing pre-trade approval for all employee and proprietary options trades, along with surveillance for suspicious activity. Front-running involves trading for one's own account or the firm's proprietary account ahead of a large customer order. The most effective control measure for preventing front-running is to establish pre-trade approval for all employee and proprietary options trades, combined with robust surveillance systems to detect suspicious activity that might indicate trading ahead of customer orders. While information barriers and post-trade reporting are also important, pre-trade approval and real-time surveillance are more proactive and directly target the core of front-running behavior. Question 29. A registered options principle, ROP, observes a registered representative, RR, attempting to open an options account for a customer with an aggressive objective, where the RR appears to have limited understanding of the complex strategies they are proposing. What is the ROP's most appropriate initial action? Approve the account, assuming the RR will learn the strategies as they go. B. Require the RR to demonstrate a thorough understanding of the proposed strategies before the account can proceed, and potentially provide remedial training. C. Directly contact the customer to explain the strategies themselves, bypassing the RR. Disapprove the account solely based on the RR's lack of understanding, without further assessment of the customer. Answer. B. Require the RR to demonstrate a thorough understanding of the proposed strategies before the account can proceed, and potentially provide remedial training. An ROP has a fundamental supervisory duty to ensure that registered representatives are competent and understand the products and strategies they recommend to customers. If an RR demonstrates a limited understanding of complex option strategies, the ROP's most appropriate immediate action is to halt the process, require the RR to demonstrate proficiency, and provide necessary remedial training. Allowing an RR to recommend strategies they don't fully grasp poses significant risks to customers and violates supervisory obligations. While customer suitability is still paramount, the RR's competence is a prerequisite for facilitating suitable recommendations. Question 30. A registered options principle, ROP, must verify that new options account applications include all essential information. Which of the following pieces of information is least critical for determining a customer's suitability for options trading? Customer's employment status and occupation. B. Customer's marital status and number of dependents. C. Customer's investment experience and knowledge. D. Customer's liquid net worth and annual income. Answer. B. Customer's marital status and number of dependents. While collecting comprehensive customer data is important, the customer's marital status and number of dependents, while providing context, are generally least critical for directly determining suitability for options trading. More essential factors include employment, investment experience, knowledge of options, financial resources, liquid net worth, income, and investment objectives and risk tolerance, as these directly bear on the customer's ability to understand and financially sustain the risks of options trading. Marital status and dependence are more pertinent for general financial planning or estate considerations, but less directly for options suitability. Question 31. Under FINRA rules, how often must a firm's written supervisory procedures, WSPs, be reviewed and updated by an options principal? Only when there are changes in regulatory requirements. B. Annually or more frequently if there are significant changes in business activities or regulations. C. Biennially to align with FINRA's examination cycles. Upon the transfer of a new options principal to the firm. Answer: B. Annually or more frequently if there are significant changes in business activities or regulations. FINRA rules require that a firm's written supervisory procedures, WSPs, be reviewed and, if necessary, updated at least annually. However, an options principal should initiate more frequent reviews and updates whenever there are significant changes in the firm's business activities, the types of options products offered, technological advancements, or, most critically, changes in relevant FINRA, exchange, or federal securities regulations. This ensures the WSPs remain current, comprehensive, and effective in providing proper supervision and mitigating risks. Question 32. A registered options principal, ROP, receives a request from a registered representative, R, to open a joint options account for two unrelated individuals, where one individual will provide all the capital and the other will manage all the trading decisions. What is the ROP's primary concern? Ensuring both individuals have signed the options disclosure document. B. The potential for unauthorized trading by the managing individual on behalf of the funding individual. C. The tax implications of options trading in a joint account with unequal contributions. D. Confirming that both individuals are suitable for options trading, even if only one is actively managing the account. Answer: A. Confirming that both individuals are suitable for options trading, even if only one is actively managing the account. In a joint options account, even if one party provides capital and the other manages trades, both individuals are considered account holders and are jointly and severally liable. Therefore, the registered options principal's, ROP, primary concern is to ensure that both individuals are suitable for options trading, meaning both understand the risks, have the financial capacity, and their investment objectives align with the proposed strategies. Failure to assess suitability for both parties could lead to significant regulatory violations and potential harm to the less knowledgeable or less financially secure individual. Question 33. A registered options principal, ROP, is reviewing customer communications for a branch office. The ROP observes several emails sent by a registered representative, R, to multiple customers that discuss specific option strategies, but do not include the required risk disclosures or the firm's name. How should the ROP categorize these communications? Informal correspondence, not subject to stringent review. B. Retail communications, requiring principal approval and specific disclosures. C. Sales literature, subject to FINRA filing requirements. D. Educational materials, exempt from standard communication rules. Answer: B. Retail communications, requiring principal approval and specific disclosures. According to FINRA Rule 2210, any written or electronic communication distributed to more than 25 retail customers within any 30 calendar day period is considered retail communication. Such communications, especially concerning options, must be approved by a registered options principal, include balanced risk disclosures, and clearly identify the firm. The described emails sent to multiple customers discussing strategies without required disclosures strongly fall under this definition and represent a serious supervisory lapse requiring immediate corrective action. Question 34. A firm's options principal determines that a registered representative, RR, has failed to disclose material information regarding the risks of a complex options strategy to a customer. Which of the following regulatory actions is most likely to be imposed on the RR? A verbal warning from the firm's compliance department. B. A monetary fine from FINRA for unsuitable recommendations. C. Suspension from association with any FINRA member firm. D. A requirement to complete additional continuing education modules. Answer: B. A monetary fine from FINRA for unsuitable recommendations. Failing to disclose material information regarding the risks of a complex options strategy directly relates to making unsuitable recommendations. This is a serious violation of FINRA's suitability rules and principles of fair dealing. While the specific penalty depends on the severity and frequency of the violation, a monetary fine from FINRA for unsuitable recommendations is a very common regulatory action imposed on registered representatives for such misconduct. Suspension is possible for more egregious or repeated violations, and a verbal warning is typically an internal firm action. Question 35. Which of the following supervisory tasks is least likely to be delegated by a registered options principal, ROP, to an unregistered assistant? Maintaining records of options disclosure document, ODD, deliveries. B. Reviewing and approving new options account applications for suitability. C. Monitoring options position limits across customer accounts. D. Preparing statistical reports on options trading activity. Answer, B. Reviewing and approving new options account applications for suitability. The review and approval of new options account applications for suitability is a critical function requiring the specialized knowledge and regulatory registration of a principal, specifically a registered options principal, ROP. This responsibility involves making complex judgments regarding a customer's financial capacity, investment experience, and risk tolerance, which cannot be delegated to an unregistered assistant. While other tasks like record keeping, data monitoring, and report preparation can often be delegated, suitability approval is non-delegable.